So on today's video, we are going to talk about the reason why past performance might be hindering your investment portfolio. Here is the trap that so many people fall into.
It's a trap!
When people are putting together their investment portfolio, what many people say to do is to look back at what funds have performed the best over time and use those funds in your investment portfolio. I am here to tell you that that could be a trap. When you look at market history and you look at actively managed mutual funds, you see a phenomenon happen where a fund that has outperformed the market over a period of time will then start to underperform the market for a long period of time. The reason for this is mean reversion. What do I mean by that? A mean reversion simply means that if a mutual fund has been outperforming the market, it will then underperform until it reaches the average of what the market actually does. When you look at modern portfolio theory, it states that all the information known about securities is already priced into their market price. That would mean over a long period of time, it would be super hard for you to outperform the market. That's why these funds eventually revert back to the mean. When we talk about mean reversion, I think of a quote from one of the greatest investors of all time, John Bogle. Jack is actually the founder of Vanguard, and he said this: "Never forget reversion to the mean. Strong performance by a mutual fund is highly likely to revert back to the stock market norm, and often below it. Remember the biblical injunction, so the last shall be first, and the first last." The second reason why your fund with great past performance will outperform in the future is this. So many mutual funds with a great track record start off small, and as their track record becomes better and better, more and more people, just like you, get excited about that mutual fund. This leads to a massive impouring of money into the fund. When that money comes into the fund has to invest that. However, there might not be the same investment opportunities there were when that fund did so well. The fund will then buy whatever it's available to them at that moment. This can then lead to underperformance. If the fund doesn't invest its money, it could leave it in cash, which again will lead to underperformance in the market. The last reason for this would simply be just because it's done well in the past doesn't mean it's going to continue to do well. It could have just been luck that it outperformed the market to begin with. When you are looking to build your own portfolio, you want to be globally diversified. You want to buy in the United States. You want to buy internationally. You want to buy emerging markets, simply for the reason we don't know what is going to perform best over the next 10 years. When you globally diversify, you could get a little bit frustrated with your portfolio. When you're buying everywhere in the world, there is going to be certain sectors or certain countries that underperform the US market. When that happens, it's very frustrating. However, over time, a globally diversified portfolio will outperform a portfolio based on one certain area in the world. Diversification means you're going to be unhappy with something in your portfolio, but that is a good thing. Be patient with it. The second thing that you should do is you should keep your portfolio as passive as possible. Once you buy a portfolio, you don't want to be making a lot of changes. You want to keep it as cheap as possible, which means you don't want the trading. You don't want to be switching funds in and out over a long period of time, because that cost can actually drag down the performance of your portfolio. This is another reason why active managers struggle to outperform the market as a whole. Remember this: when you have your diversified portfolio, you want to stick with your investment program. Again, I'm going to quote John Bogle here. He says, "Stay the course. Regardless of what happens in the markets, stick to your investment program. Changing your investment strategy at the wrong time can be the single most devastating mistake you can make as an investor." Just ask investors who moved a significant portion of their portfolio to cash during the depths of the financial crisis, only to miss out on part or even all of the subsequent 8-year and counting bull market that we have enjoyed ever since. Stay the course is the most important piece of advice I can give you. I do want to say that you can be active in a few things. Be active in your portfolio with your values. An example of this for me and my family is that we're extremely passionate about families, keeping families together, supporting kids in the foster care system through adoption. However, I owned some companies overseas that were violating child labor laws. This went directly against my values, so I chose to eliminate them from my portfolio. It is always good when you align your portfolios with your values. Also, be active in your portfolio looking at academic research on investing. When you look at what has caused long-term outperformance in the market, it can be tied back to a few different specific things. One, owning value stocks. Value stocks are normally securities that are underpriced for some reason. When you buy these stocks, think about mean reversion. These are stocks that will probably end up outperforming in the future. Academic research also shows that smaller company stocks will outperform larger company stocks over a long period of time without incurring much more risk in the portfolio. The risk-adjusted returns for smaller company stocks are actually higher than the risk-adjusted returns for larger companies in a portfolio. The third way that your portfolio could potentially outperform over a long period of time is by holding more profitable companies in the portfolio. If there are two companies that do the exact same thing, but one company has found a way to do it more profitably, that company will probably outperform the other company that is less profitable. So how does this tie back to Redeem Wealth? At Redeem Wealth, we build our investment portfolios in the structure that we just talked about. We want to help you build a globally diversified portfolio that aligns with your values, that looks at academic research, that will help you have a long-term successful investment experience. If this is something that you are interested in partnering with us, we would love to talk with you more. Click the link below to schedule some time with us today.